Hello, good morning to all and happy Friday. I'm Kelvin here again. Welcome back to today's Daily Dose of Market Insights. Very good morning. Today will be Friday, the 4th of July 2025. Test. Okay, I think there's something with okay. Very good morning to all. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights and happy Friday. Today will be the 4th of July 2025. So before we kickstart our gist of today's daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term intraday technical outlook on those various broad-based cross-asset classes that we cover, the 4 US dollar major pair, the major stock indices, and the 2 key commodities market, i.e. Gold XAU/USD and the West Texas crude oil, let's have a quick recap what has taken shape yesterday and as well as in early today's Asia session before 11 a.m. That's the start of our daily dose. What are the key economic drivers, news flow that is impacting the intraday movement of these broad-based cross-asset classes? So let us start with the movement of the major US stock indices first yesterday. So within our expectation, all the major US stock indices continues to get bidder up. So those who followed my daily dose of market insights on a frequent basis, we have flipped back to a bullish bias since 2 weeks, 1.5 weeks ago, I would say, respecting the ongoing bullish momentum in the major US stock indices, despite they are climbing out a wall of worry, i.e. meaning that we are now approaching the 9th of July expiry date of US White House administration higher reciprocal tariff that may kick in if deals are not being concluded by that. All right, so but nevertheless, all the 4 major stock indices continues to rally, and the higher beta indices, which is the Nasdaq 100, continues to outperform with a gain of 1%, on par with the small cap Russell 2000 at 1.02%. The SPX is up by 0.83%, and trailing behind will be the more defensive oriented indices, a major US stock indices, pardon me, the Dow Jones Industrial Average, which is up by 0.8%. So if you look at the heat map of the S&P 500, we see almost an entire sea of green in all the sector, except for the defensive sector, which is healthcare. We see some pockets of red over here, and as well as consumer staples, which is also some pockets of reds over here as well. But the mega cap growth, the mega cap higher beta technology stocks, Microsoft, Apple, Amazon, Nvidia, Google, Meta, with the exception of Tesla, that is down by 0.10% due to the fact that we have the passage of Trump's one big beautiful tax cut bill that has so-called reduce subsidies for green related products or services, which Tesla is part of this EV, which is part of this green product services in US. They will receive less state subsidies going forward, so that potentially could cramp down profit growth potential for Tesla related products over here. So that's actually explained to them why the underperformance of the Tesla stock within the mega cap cohort. But nevertheless, all of them are still basking in this bullish momentum. So later I'll cover the short-term intraday technical outlook on the major US stock indices that we cover on the frequent basis, which is the Wall Street 30, representing the Dow Jones Industrial Average, the S&P 500, and the Nasdaq 100 in the second segment of today's daily dose. All right, and also one of the excuse me, one of the economic driver that is actually driving this bullish momentum of that's being inherent in the major US stock indices was the positive news flow, positive economic data from the labor market and as well as the services sector. So yesterday we have the release of the non-farm payroll data. So non-farm payroll data came in way better than expected over here. So let me share with you this the screen here. So non-farm payroll data came in at 147k jobs added, and for the month of June, and that's what surpassed expectation on 110k jobs added. And even the prior month, it was revised upwards to 139k to 144k. So if you look at the trend of the non-farm payroll data in the last 6 months or so, we has been in a pretty healthy range over here. So it's gently showing signs of no clear signs of a deterioration in the non-farm payroll data, even though it's a lagging data. But however, there's one leading economic data or tier one data in the US, which is the services, ISM services data over here, which was released 1.5 hours later at 10 p.m. Singapore time. So why ISM service PMI data is important? Number one, is considered as a tier one leading economic data. Why leading economic data? Because it based on survey base. So survey base actually touch on sentiment. Hard data is only record things has already happened. So based on this survey base of we call it data that actually surveyed those purchasing managers or managers that actually has a say in driving the businesses of the services sector in the US. And why services sector in US is important? Because services activities contribute to 3/4 of US annual growth in the last 10 to 20 years, all right, over here. So the ISM services PMI data managed to bounce back into an expansionary level. Anything that is above 50 showing expansionary, anything that's below 50 showing contraction. So previous month of May, there was still a scare where it dipped down for in the contractionary mode for I think in almost a year to 49.9, and it managed to bounce back up to 50.8, slightly above expectation of 50.5. So if you look at the services PMI data over here, okay, so it managed to bounce back up after that contraction risk scare that was recorded in May in 49 point, that shows a figure of 49.9. So if you look at the 10-year trend, so previously when it bounced back to 49.9, so that was the first contraction since June 2024. So they managed to see a U-turn over here, but so far it hasn't broken up above a series of lower high yet, right, at this point. But nevertheless, that bounced off from that previous scale of 49.9 in the month of May and going above expectation of 50.5. All right, over here, post market is expecting a slight expectation of 50.5. All right, so that actually also create a positive feedback loop into the US stock market. So the key reason over here is that yes, we see data being positive. That means i.e. That actually create a growth momentum that is still in we call it earnings growth momentum that could potentially drive the US stock market higher, despite we are now climbing up a wall of worry. So we continue to respect the price level or the price momentum of the major US stock indices, as I share you the second segment of the daily dose. But however, this very strong US data, tier one data, I would say, the non-farm payroll, and as well as the ISM services PMI, reduces the chance of one more interest rate cut from the Fed this year. So like I mentioned yesterday, prior to this release of this data, there was actually a high expectation, about close to about 60%, that market in the Fed funds futures market is expecting the Fed to do 3 cuts in 2025, one in September, one in October, and previously 2 weeks ago there was a very low chance to come in December. So yesterday, prior to the release of non-farm payroll and ISM services PMI, there's high hopes of 60% chance that the Fed will engineer a third cut of 25 basis point each to bring the Fed funds rate lower. But after the release of these two tier one data, the third cut has been reduced greatly. So what do I mean by that? And also the July meeting, the 30th of July meeting, has increased almost 100% that the Fed will not cut at all. So let me share what I mean. So previously, one day before the release of the non-farm payroll data and the ISM services PMI data, there's 76% chance that the Fed will hold. Then now the Fed will hold at 95% chance. So put in a way that it's almost 100% chance that there will be no cut at all in the 30th of July meeting, despite the fact that we previously have two Federal Reserve officials in the last week mentioning their favoritism to skew towards the dovish side and at night the first cut in July. So after that rosy job data and the services PMI data, that killed off this expectation. So how about the rest of the months over here? So the rest of the months, if you look at the aggregator tab over here, all right, so we have the 72% chance that the Fed will cut in September. Then after cutting in September, there will be no further cut in October, only a 34% chance. So a 66% chance that the Fed will stand pat and will only engineer the second cut to come in the 10th of December 2025 FOMC meeting. So that's the last meeting of 2025. So previously, yesterday, prior to the release of the non-farm payroll data and ISM services PMI data, there's actually 60% chance that the Fed will do the third cut in the 10th of December FOMC meeting to bring down the Fed funds rate to 3.5%. So now market now align the Fed funds rate expectation to be only two cuts. The first cut coming in the 17th of September meeting. The second cut coming in the last meeting of 2025, which is the 10th of December, to bring it down to 3.75% to 4%. So that's actually in line with the latest dot plot that was released in the June FOMC meeting, where it actually illustrates the median Federal Reserve officials projection on where the Fed funds rate will be in by the end of 2025. So they actually expect only two potential interest rate cuts for 2025 at 3.75 to bring it down to 3.75% to 4%. So with that lower chance of a third cut that is being priced in by the Fed funds futures market, that actually saw a dollar strength snap back yesterday. So what do I mean by that? So if you look at the US dollar index over here, previously since the bearish reaction on 23rd of June, right exactly at the 20-day and the 50-day moving average, it has been trading in 1, 2, 3, 4, 5, 6, 7 consecutive day of bearish candlestick on lower closes, and also broke down below the 97.4% key long-term support level, okay, previously. So this 97.4% is a very important level. Why? Because let me go back to the monthly chart. So this 94, the break of this 97.4 constitute a bearish breakdown of a long-term ascending channel support that was previously in place since May 2011 low. So this breakage of 97.4 increased the odds of a start of a major medium term to major downtrend phase. But on a very short term basis, if you look at the daily time frame chart, after this 7 consecutive day of rally, or after this 7 consecutive day of down move on the US dollar index. So this US dollar index, I use the US dollar index to give me a gauge of the broad-based movement of the US dollar, because this is being an index, composite index over here of a major currency. So it broke down. It has a 7 consecutive day of down move of lower low closes, and after this 7 day of down move, there's actually a risk of a retracement over here, of a pullback. So this pullback yesterday, it managed to seize the second day of bounce. So now there could be a risk after this 2 day of bounce. There could be further bounces for at least 1 to 2 more days to retest the 97.4, which is also the 20-day moving average, I think, as a near-term resistance level as well. All right. So on a very short-term basis, there could be this mean reversion rebound that could potentially seek out this dollar index bouncing back to 97.4, which i.e. Represent what I call some form of dollar strength coming back into the FX market in the shorter term. So still recall yesterday we flipped to a we call it dollar strength story against two currency pair, which is the sterling dollar and as well as the Aussie dollar. So later I'll touch on again on the key levels of that. So the evidence has now been pretty much clear that other major dollar pair may get hit as well for this dollar mean reversion strength coming back into the FX market, at least for 1 to 2 days. all right, based on the potential trajectory that is being portrayed on the US dollar index over here. So later I'll touch more about that when I cover the second segment of today's daily dose. All right, so now let us take a look at how does the Asia benchmark stock indices perform, the Asia Pacific benchmark stock indices perform in today's session. All right, so what I could see over here is that the Nikkei 225, where is it? Yeah, the Nikkei 225 is up marginally by 0.11% after that Wednesday, Tuesday and Wednesday, yeah, after that Wednesday sell off, where US President Trump threatened to impose a higher tariff of 30% to 35% on Japanese exports heading into US, because Trump is pretty much frustrated with the slow process of negotiation between US and Japan has a refusal of allowing rice exports from US heading into the Japanese domestic market. So Trump threatened in the last few days to raise the tariff rates on Japanese products to 30 to 35% from 25% if the 9th of July deadline doesn't see any headway between these two countries. But however, from a technical perspective, I do highlight that the Japan 225, which is our platform representing Nikkei 225, is now showing some signs of bounce, because they actually bounced off from a support level and it hit the first resistance level. Okay, later I'll touch on that. So one thing, the reason why the Nikkei 225 also showing some sign of positiveness in today's intraday session is so because of we have two key Japanese data that is actually supporting this bullish move. The first Japanese data that is supporting this bullish move is this morning release of that household spending in Japan. So household spending in Japan actually came in very strong year-on-year basis for the month of May. So that is considered, take it as retail sales. It's something like consumer retail sales. So it's household spending. For May, they actually rose to 4.7%, way above market expectation of 1.2%, and so way above the previous April month of a negative figure of negative 0.1%. So if you look at the trend on the Japanese households spending over here, all right, so it's the fastest growth since August 2022. Okay, you look at the strong trend over here. All right, and also over here is that the Japanese so-called trade union has really concluded their so-called trade negotiation with the Japanese corporation in Japan, locking in the wage growth for Japanese employees for the next fiscal year of 2026. So the annual wage negotiation resulted in the average wage increase of 5.25% for workers at 5,162 companies affiliated with the nation's largest union federation, Renko. So this wage increase is the largest in 34 years and supports the central bank view that the cycle of higher wages and prices is emerging over here. All right, so the key story over here that also created a positive feedback loop into the Japanese stock market as well. All right, over here. So now other Asia performance that is still on the weaker will be the Hang Seng. So Hang Seng yesterday we flipped to a neutrality stance because of a mixed element. So today it actually went down in a rate at negative 0.81%. So one of the reason it went down in the rate of negative 1.08% is due to internal factor as well, because we know that the Hong Kong currency is being pegged in a fixed peg between 7.75% to 7.8. So what do I mean by this? The Hong Kong dollar has been trading at the weaker end of the trading band at the 7.84% against the US dollar. That means one US dollar equals to one Hong Kong dollar at 7.84% in the last few sessions. So every time it hit the 7.85%, pardon me, it hit the 7.85%, the Hong Kong Central Bank, which is the HKMA, got to come in and intervene the market by so-called buying up Hong Kong dollar, selling US dollar. So if we to buy up Hong Kong dollar, that's actually reduce the money supply domestically in Hong Kong. So with a reduction in money supply in Hong Kong, that means domestically, potentially there could be an increase in Hong Kong short-term interest rate. So with a potential increase in Hong Kong short-term interest rate, that actually created a negative feedback loop into the domestic Hong Kong stock market. That means, i.e., we know that if interest rate increases, it reduces liquidity. It reduces liquidity, it lead to what I call a negative sentiment, risk-off sentiment in for equities, because equities thrive on high liquidity environment. All right, so based on this liquidity relationship between liquidity flow and the movement of equities in the short term. So that just explained to us why the Hang Seng index actually came down in the last 2 days, because of the weaker end of the Hong Kong dollar that is being seen in the last 2 days as well, where the 1 USD is hitting the upper band at 7.85. So once hitting 7.85, the Hong Kong Central Bank, the HKMA, got to intervene in the market to push it down lower. So to intervene in the market, they got to actually buy up Hong Kong dollar. So by buying up Hong Kong dollar, that reduced Hong Kong dollar money supply domestically in Hong Kong. A reduction in domestic money supply in Hong Kong potentially increases short-term interest rate. That potentially see a potential reduction in liquidity. Reduction in liquidity lead to a risk-off environment. So at least from a shorter term, that is detrimental to the Hong Kong stock market. That's explained to us why the Hang Seng is falling for the 3 consecutive session or so. All right, but the movement later I'll share in the short-term intraday technical outlook. They actually come down to a short-term support level, and with the hourly RSI at oversold, we potentially may see some kind of bounces coming into the market, as well as the downward move has really hit a Fibo retracement level. All right, and also one of the reasons that created this negative feedback loop into the Hong Kong stock market is because of the Trump tariff trade as well. So Trump said that today, so despite the fact that today is the 4th of July, public holiday in US, but the US White House administration is working very hard overtime today to actually state that they may send out letters informing trading partners of new tariff rates as soon as on Friday over here. So US President Trump said that his administration may begin sending out letters to trading partners as soon as today, Friday, setting out unilateral tariff rates ahead of the 9th of July deadline for negotiation. So it seems to us that he's now playing the hardball game, asking those countries that are still in the process of negotiation, Japan, South Korea, and the European Union, that are still working to finalize deal, to speed up their process and to actually adhere to US requests. So he's now trying to play that hardball tactic. All right, so that actually created that a negative feedback loop into the Hong Kong stock market as well over here. And the rest of the other Asia stock market, what I could see is that the Kospi also down by negative 1.33%. The TAIEX, which is the benchmark Taiwanese stock index, is so down by negative 0.54%, and the STI, after being one of the top performing Asia Pacific stock indices at the start of this week, where they scale fresh all-time high and going above the 4,000 psychological level, they are also down by negative 0.3%. And the rest of the other Asia session is neither either Asia Pacific index is rather minute, with the ASX 200 almost unchanged at 0.05%. And also one of the reasons why the STI is down by negative 0.3%, other than that Trump trade of sending out a final letter to inform of the finalized unilateral trade rates, tariff rate ahead of the 9th of July deadline, is because of a localized factor as well, where Singapore authority actually surprised the market by adding in these cooling measures to the Singapore red hot property market, despite that in the last few months, the property prices in Singapore has started to slow down, especially on the private property prices. So Singapore government introduced new measures to control housing prices, including raising the stamp duty for those who sell their private homes within 4 years, and increase the rates payable to 16% from 12% within the first year. All right, so that actually also created a bit of negative feedback loop into the local STI benchmark stock index. All right, so that pretty much sum up the first segment of today's daily dose. So let me now move on to the second segment, which I will cover the intraday technical outlook on those broad-based cross asset classes that we follow on a daily basis. All right, so before that, let me expand my screen. right over here. So let me touch on with the FX market first over here. So for the FX market, like I do mention, there could be the risk of a dollar strength bounce or mean reversion rebound, and that actually is being seen on the euro dollar. All right, over here. So we know that the euro dollar, we have been watching closely this first support level at 117.45, my pivotal support. So this pivotal support managed to help on Wednesday. It bounces up, can't break above the first resistance at 118.10, 118.25 before it sold off on the onset of the release of the non-farm payroll data, and thereafter at the release of the strong ISM services PMI data as well, but managed to survive so far. But upon managed to survive, if you look at the price section, it has been rather lackluster. The bounce is not so convincing enough over here by showing the very small little candlestick body itself. And if you look at the RSI, continues to slope downwards, and right now it's being guarded or kept below by this parallel descending trend line at parallel descending trend line resistance at around the 55 level mark over here. So with that, there could be some signs that this move itself has already ended. I mean, we have a so-called a 1, 2, 3, 4, 5, a 5-wave move up has really ended based on the elliott wave perspective. So after this 5-wave move up ended, there could be now a risk of a minor corrective retracement or corrective decline retracement to retrace at least 38% to 50% of this move over here, of this prior 5-wave up from the low of this 23rd of June all the way up to that high of 1st of July, which is Tuesday. We start to see the 30% and the 50% retracement at the 116.85 at 116.30 level. So with that, we will flip to a bearish bias for today, looking out for potentially a minor corrective pullback sequence to take place before another impulsive up move resume. That means, i.e., a mean reversion decline to take place close to the 20-day moving average before another bullish up leg continues on the euro dollar. So it's just only a very short term bearish bias view. So using 118.10 slash 118.25 as my short term pivotal resistance, a breakdown below 117.45 exposes the next near term support at 116.85 and 116.30. So this will be the two desired levels to watch out for this ongoing mean or for this potential mean reversion decline corrective pullback sequence to take hold. Only a bullish push up above 118.25 and an hourly close above it will invalidate this bearish bias of this mean reversion corrective decline pullback sequence to continue the impulsive up move wave or up leg to expose the next resistance level on the near term basis at 118.70 followed by 119.10. So that's for the euro dollar. Next up will be the sterling dollar. So sterling dollar can't break above our pivotal resistance that we highlighted yesterday, which is at 136.70, 136.90 over here. So we continue to watch this pivotal resistance level. Yesterday, it almost hit the first support level and it bounces. So as long as 136.90 short-term pivotal resistance holds, we still attempt to have another view of a bearish corrective decline, a minor corrective decline sequence over here, retesting 135.70. A breakdown below it exposes the 50-day moving average, which is confluencing at the next near-term support level at 134.70 as well, 134.70 over here. All right, this minor congestion area of 20th of June. Okay, only a bullish breakout and an hourly close above 136.90 that would invalidate today's intraday minor corrective decline sequence scenario and see the continuation of the impulsive up move to revisit 138 figure, 138.30 in the first step. So that's for the sterling dollar. Next up will be the Aussie dollar. So the Aussie dollar yesterday, we have this 66 figure as my short-term pivotal resistance level. Price action indeed has a bearish reaction of it, almost hit 65.30 before bouncing. Then thereafter, we see a series of lackluster candlestick, and the hourly RSI continues to print a series of lower high, and right now it inches back down below the 50 level mark, indicating the lack of upside momentum. So still no change, still using that 66 figure level as my short-term pivotal resistance level, maintaining our intraday trend bearish bias for this minor corrective decline pullback decline slash pullback sequence to play out. First support level 66.30 followed by 65.10. So this is like a zone. So once it hit this zone at 65.30, 65.10, I'll be on the lookout for bullish reversal candlestick again to flip back to a bullish bias, given the fact that the medium term uptrend still remains intact after that bullish breakout of that 7-week of range configuration that has taken shape on last Monday or so over here, and price action also continues to hold above the rising 20-day moving average. So this could be a potential sweet spot over here, 65.30 slash 65.10 to flip back to a bullish bias again. So for now, hourly momentum indicator is still potentially supporting a minor corrective pullback sequence, holding below the 66 short-term pivotal resistance level. Only a bullish breakout and the hourly close above 66 figure level will invalidate today's short-term intraday bearish bias to see the continuation of the impulsive upmove sequence taking hold, exposing the next near-term resistance level in first step at 66.30 slash 66.45 next. Okay, next up will be the dollar yen. So what you see over here is that the dollar yen on the daily time frame continues to trade in a very whipsaw way. So it's going to be trapped inside this range configuration that has been taking shape since the low of 22nd of April. So this is a very complex range configuration. So yesterday price action reintegrate back above this ascending range support level, this dotted gray line over here. All right, it reintegrate back above it. So with this rather choppy price action that's being seen on the dollar yen for today, so the dollar yen yesterday we have a very tight short-term pivotal resistance level at 44.15, pierce above it, hit the next resistance level before shaping that bearish reaction of it over here, and right now is trying to actually go back down below the 20 and the 50-day moving average. So with that rather mixed element, I would say right now, but the hourly RSI is bearish, all right, over here. Okay, so with this mixed element that's being seen as is still reintegrate back above this dotted red line over here, which was the former ascending range support from 22nd of April. So now it will be at 44.15 level, which is also the former minor swing high of 2nd of July, where this price action broke yesterday, and you see the very sharp bullish hourly candle, all right, yesterday. So with this 44.15 is a very important inflection level. So with that, we will have no conviction of any directional bias for the dollar yen for today. So neutral between 145.20, which was at our resistance level that it made yesterday after the break above of the 44.15, and on the downside of the neutrality range will be 44.15 as well. So break below 44.15 will also indicate a bearish breakdown below the ascending range support from 22nd of April, indicating yesterday's this push up over here is a failure bullish breakout, and price action may reintegrate, may actually give way to the best again to revisit 143.50 followed by 142.80 in the first step, which is the minor swing low of 1st of July, this Tuesday. So given the fact of a rather choppy movement right now on the dollar yen, I prefer to have a neutrality stance right now, neutral between 145.20 and 144.15, but I'll be watching very closely the lower neutrality limit of 144.15 to actually be something like a downside trigger level to potentially flip back my buyers back towards the bearish side of the story again. Right, so that's for the dollar yen, and that also sum up the intraday technical outlook on these 4 major dollar pair, okay, that we cover on the daily basis. So let us move our attention now to the major stock indices, starting with the Hong Kong 33 representing the Hang Seng Index. So the Hang Seng Index yesterday we were neutral between 24,270 and 23,880, looking for it to come down towards this support zone here at 23,690. 23,330. So it already made the first support zone at 23,690 slash 23,560. 23,330 is the lower limit of this minor ascending channel that is still in place in 2nd of June, and also the rising 50-day moving average as well. And if you do the Fibo retracement of this previous push up from the low of 20th of June all the way up to the high of the recent high of 25th of June, this movement here has already made the golden ratio of the 61.8% and the 76.4% coincide exactly at very closely at 23,330, and which is also the rising 50-day moving average. So given the fact that this pullback of this down move in the early Asia session has already met its so-called bearish objective in the short term, so we will be now flipping back to a bullish bias given that the bearish objective has already been met. So keeping the short-term pivotal support level at 23,330, which is a much more important level. Why? Because it's confluence with two important technical elements: the lower limit of that minor ascending channel, and as well as the rising day 50-day moving average as well over here. Okay, where previously the 50-day moving average provide a good support for this intraday sell-off that has taken shape from 29th of May to 30th of May over here. This sharp sell-off, then thereafter it gives that V-shaped recovery. So that is a important moving average of the 50-day moving average. So that's why I'm using 23,330 as my short-term pivotal support instead of using 23,690/570. So 23,330 short-term pivotal support, flip back to a intraday bullish bias. Breakout above 23,880 will increase the odds of this bullish bias to revisit the minor swing high area of this Wednesday at 24,270 in the first step. All right. However, if the price action break down below 23,330 with an hourly close below it, then this minor corrective decline sequence will extend further to the downside, exposing the next support level at 23,060. Below it sees the minor swing low area of 2nd of June coming into play at 22,680. So that's for the Hong Kong 33. Next up will be the Nikkei 225 over here. So the Nikkei 225 managed to hit our first resistance level at 40,040 before shipping that sell off in today's Asia session. All right. So with that, the level still remain unchanged. So still using that low on this Wednesday here as my pivotal support level at 39,390. So in order for the boost to gain traction today, it got to break out fast above 40,040 again, and with that, the next near-term resistance will come in at 40,355, which is the minor congestion area of 30th of June. All right. However, if price action break down below 39,390, then this potential corrective decline sequence from previously from 20th of June all the way down to 2nd of July may extend further to the downside to revisit 39,145 and retest the rising 20-day moving average at 38,850, which is also the pullback support of an important pullback support of that previous range ascending triangle range configuration that is in place since 12th of March, broken up on 25th of June. So this is a very important support level because that constitute 7-month plus of previous 7-week plus of range resistance now turns into a pullback support at 38,850, also constitute with the rising 20-day moving average. Okay, so that's for the Japan 225. Next up will be the Germany 30 over here. So the German 30 also hit higher, rose higher, hit our first resistance level at 23,890, and right now is trading down below it over here, but still holding above this kind of a support level. So still no change. Right now, still holding above the 20-day moving average over here, the 20-day moving average. So with that, I'll be using a slightly adjusted pivotal support level for today, which coincide with yesterday's European session low and the former minor swing high area of 24th of June and 25th of June over here. So slightly adjusted upwards to 23,770. So that will be my adjusted short-term pivotal support for the Germany 30 representing the German DAX. So maintain our intraday bullish bias. Resistance level to watch in first step 24,110, followed by 24,260, which is the one-time Fibo extension taken from the low of 20th of June and the minor congestion area of 6th of June and 10th of June. However, if price action break down below 23,770, that would invalidate today's intraday bullish bias to kickstart a choppy minor corrective decline to expose the next near-term support level at 23,570, which is so confluence with the rising 50-day moving average. Only a breakdown below 23,570 will see a deeper minor corrective pullback all the way down to 23,440, And if this level can't hold, it may revisit the minor swing low area of 20th of June at 23,150, and that also constitute close to the golden ratio as the 76 point. Okay, slightly below the 76.4% Fibo retracement. Okay, so the all important one is at the 23,440 because that constitute with the golden ratio of 61.8 over here. Right, so that's for the Germany 30. Next up will be the US Wall Street indices. So before we start the US Wall Street indices, just a quick reminder, today the US cash market, which is the cash stock market, is closed for a public holiday, so liquidity will be pretty much lower over here. Right, for the US stock indices. So the US stock indices, starting with the US Wall Street 30, which represents the Dow Jones Industrial Average, rallied as expected over here. So it cleared above our first resistance level at 44,750/820, almost hit the all-time high level at 45,100, printed a high of 44,743 before pulling back minorly. Okay, so with that, I will have a first support level to watch for today. Will be this area here. Okay, this congestion area at 44,620. So I will have a tighten short-term pivotal support level taking into account of yesterday's bounce right off the start of the US session at 44,400. So using a tighten short-term pivotal support level for the US Wall Street 30 representing the Dow Jones Industrial Average, 44,400, maintain our intraday trend bullish bias. First resistance to watch will be the current all-time high at 45,100. We also coincide with the upper limit of this minor ascending channel from the low of 20th of June above 45,100, pardon me, exposes the next intermediate resistance level at 45,455, 45,520, which constitute with a Fibo extension, which is defined by a Fibo extension cluster level. Excuse me. Only a breakdown in the hourly close below 44,400 invalidate today's intraday trend bullish bias to kickstart a minor corrective pullback sequence, exposing the next near-term support level at 44,170/43,965 right over here. So that's for the US Wall Street 30. Next up will be the SPX 500. So the SPX 500 also hit our first resistance level before pulling back slightly. So still continues to trade within this minor ascending channel that is I draw from the low of 23rd of June. So with that, first support level to watch will be at 6,250, which is the lower limit of this minor ascending channel. Pivotal support level, I will tighten it slightly upwards to take into account of the former minor range resistance of 1st of July and 2nd of July, where it was taken out yesterday at 6,220, now turns into a key short-term pullback support. So using 6,220 as my tighten short-term pivotal resistance level, we will maintain our intraday trend bullish bias on the SPX 500, looking forward to scale new fresh all-time high. Next resistance level to watch 6,330, 6,355, which is a 0.764 Fibo extension. Okay, give me a minute. Not 0.764. Is this level here. I did it. Okay, 1.236 from the previous minor swing low of 23rd of May, and above 6,355 exposes 6,370, 6,380, which is a Fibo extension cluster level. All right, only a bearish breakdown and an hourly close below 6,220 that would invalidate today's intraday bullish bias to kickstart a minor corrective decline sequence again, exposing 6,180, which is the pullback area of that former ascending wedge resistance, now turns into a pullback support, which is the dotted gray line over here. Next up will be the Nasdaq 100. So the Nasdaq 100 also continues to trade in this minor ascending channel taken from the low of 23rd of June. So yesterday it already hit our first resistance level at this yesterday I put it somewhere around 22,850, hit the level, and right now the RSI is now exited from the overbought level, but there is no bearish divergence as price sessions see a higher high over here. So with that, that could be a risk of a minor pullback taking shape before another bullish up leg resume for the Nasdaq 100. So minor pullback, first support level to watch will be the former minor swing high of 30th of June and 1st of July, where it broke out yesterday and see a very strong bullish candlestick at the p.m. mark Singapore time. That also coincides with the November payroll data. So with that, this 22,710 will be the first support level to watch. Maximum level will be the 22,600 to hold this minor corrective pullback sequence on the Nasdaq 100, which is also coincide with the lower limit of this minor ascending channel. So as long as this pullback didn't surpass below 22,600, we will still maintain our bullish bias for the Nasdaq 100 to scale fresh all-time high, with the next resistance level at 23,190 next, which constitute the correspond with the upper limit of this minor ascending channel upper limit and a Fibo extension cluster level as well. Only a bearish breakdown and hourly close below 22,600 will invalidate the intraday bullish bias to see a much more pronounced, deeper minor corrective decline, exposing the next near-term support level at 22,360, which is also confluence with the congestion area of 26th of June and 27th of June, very close to 2nd of July, the minor swing low, and as well as the pullback support of that former ascending wedge range resistance now turns into a pullback support, which is this dotted gray line over here. All right, so that sum up the intraday technical outlook on all the major stock indices. So now let's focus our attention to the commodities market, starting with the gold XAU/USD. So for gold XAU/USD continues to be trapped within the 20-day moving average and as well as the 50-day moving average that is providing a good support level since Wednesday this week. All right, so yesterday there was a massive intraday sell-off after the release of the November payroll data, but come break below 3,318, the 50-day moving average, and as well as our short-term pivotal support level that we highlighted 2 days ago to maintain our bullish bias over here. And what we could see is that the hourly RSI now has also turned positive after bouncing up from a parallel ascending trend line support and also bouncing back up above the 50 level mark, indicating some form of bullish momentum that is coming back into the picture. So still no change for sure. 3,318 is an inflection level for the bulls, or a key short-term pivotal support that we need to maintain for today in order to maintain our bullish bias. Upside figure level will be the close to the 20-day moving average, which is also the minor swing high of this Thursday at 3,360. A breakout above 3,360 will increase the odds for the bulls to expose the next near-term resistance level in first step at 3,400. So still maintaining our intraday bullish bias, watching 3,318 as my short-term pivotal support that managed to survive after yesterday's sell-off upon the release of key US economic data, non-farm payroll data, and the upside trigger level will be at 3,360 potentially. Only a breakdown in the hourly close below 3,318 that would invalidate today's intraday bullish bias for gold XAU/USD, and that would potentially see the start of another round of choppy corrective decline, exposing 32.93, a breakdown below 32.93, revisit this Monday 30th of June minor swing low at 32.50 next. So that's for gold XAU/USD. Next up, lastly, will be the West Texas oil. So for West Texas oil over here, it tries to actually trade sideways. And what we could see over here is that it can't have any headway above the 20-day moving average and below the 200-day moving average. And we see a series of higher low. Over here, same high, okay, same high, almost same high, but lower high on the RSI. So this also constitute as a bearish divergence, almost similar high, similar minor swing high on the price action, but lower high on the hourly RSI. So that is a bearish divergence, indicating the lack of upside momentum right below the intersection of the 20-day moving average and the 200-day moving average. So with that, we also right below this former major descending resistance from 28th of September 2023 high that see a choppy up move during the onset of the Israel-Iran conflict on the 13th of June previously, and thereafter it see a bearish reintegration back below it again. Then after it attempt to do a bounce, but this bounce is losing upside momentum by the appearance of this bearish divergence on the hourly RSI. So with that, we will flip back to a bearish bias using 69.15/70.60 as my short-term pivotal resistance zone for today. Downside trigger level to watch will be 66.65. A breakdown below 66.65 may expose 64.05 next, which is the confluence with the 50-day moving average as well. Only a bullish breakout and the hourly close above 70.60 will invalidate today's intraday bearish bias to see a squeeze up towards 73.60 next. So that's for West Texas Oil. And that also sum up the intraday technical outlook on all the broad-based cross asset classes that we cover on a daily basis. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? And like I mentioned, today will be the closure of the US stock market, 4th of July for the National Day. So once the US market open, it could be a much more lower liquidity session for this Friday. All right, so this Friday over here, we do have at the start of the European session, 3:30 p.m. ECB President Lagarde speech that may impact the euro dollar, the euro crosses, and the Germany 30, something to look out for. And going forward, we will have a rather quiet session over here, no key data, except for at on Sunday. Sunday over here, we do have a Bank of England Governor Bentley's speech at 12:45 a.m. So that could potentially influence the sterling dollar or the FX market once the Asia session opens on Monday. 7 of on Monday itself. And also on Sunday, we have the OPEC Plus meeting as well, where potentially there could be an increase of oil supply coming up from OPEC Plus. So that could potentially influence the oil prices when Asia session open on Monday itself. All right, so that potentially sum up today's Daily Dose of Market Insight. I wish you a restful and great weekend, and we shall speak again on Monday. Thank you.